So, hey guys, Michael Manatskanen here from Owners Club and Super Investors, and I want to thank you guys very much for being here tonight. Obviously, the goal of today's call is to explain how I was able to raise over $800,000 in 72 hours to buy a portfolio of co-living rentals, $2.2 million portfolio of co-living rentals. For anyone that's not familiar, I utilize the platform Fractional, which is allows people to invest in your investments and maintain fractional ownership, whether they're coming in as a private money lender or private money partner. It just depends on the way you structure the deal, the investor or sponsor structures the deal. So we're going to go into all of that. And then there's going to be plenty of Q&A. So we're going to go over what is fractional, how it works, their pricing model, and kind of my recommendations based on analyzing it with various investment strategies, why I chose fractional for this recent capital raise and why I would use it for specific types of deals that I think make a lot of sense for it. Building and launching my actual fractional capital raise, the event, the timeline, all of that stuff. I hope you wouldn't follow my timeline. I didn't do it well. I basically did it with my back against the wall. We'll go over the actual capital raise so you can see, the actual event. We'll go over the project, all that good stuff. I'll show you some of the marketing material that I used. Whatever wasn't removed from Facebook. Some of that stuff was removed. And then kind of what I did to engage with investors, manage the capital raise as it was occurring, the post-raise process, so what that looked like once we were funded, what that process has looked like since then, and then handling any Q&A for you guys. So with that being said, let's get started. So we're going to start with an overview of Fractional. Fractional is a real estate investment platform that simplifies fractional ownership of properties. Basically, you can decide if you're going to allow fractional ownership in the sense of like what I did, a private money partnership, where my partners actually own the asset with me, or you are allowing people to pool their funds together in like an investment club or whatever they call it to avoid, SEC regulation. So they can lend that collectively. Each person puts in $5,000 collectively to raise $100,000, which then gets invested as private money loans, which is what Pace has done for a couple fix and flips and the recent $1 million that he raised. So it's pretty awesome because it works really well for capital partners, just like it does if you're a private money lender, private money partner. You can then be a co-owner or lender on assets without actually worrying with the direct management. The platform really simplifies the investment process. They handle like legal structuring, compliance, operational details. They have their own process. And so it's not just for the capital raise, but more. And I'll kind of show that visually because it's just a lot of words. And then it's great because it's a platform that's best utilized by experienced and newer capital partners, people who want to maybe put in their first couple $1,000s for investing, or I would say it's great for newer and experienced borrowers. But in my opinion, when you're raising money, you should have some level of experience. I'm not saying you need to be Warren Buffett or Pace Morby or whatever, but you should have some level of, experience as an investor, ideally using some of your own funds initially when starting out, or at least have some of your own capital set aside prior to raising capital. But that's ultimately up to you and your partners how you decide to proceed. So it's great whether you are experienced or not. It's not like fractional is verifying that piece. And then for capital partners, it's great because they can get into investments whether they're brand new or they're experienced. They can get into these deals with little amount. I think you can go as low as $5,000. I allowed my partners to have, since it was a private money partnership, I allowed them to have, the minimum entry was $25,000 per person. And then I kind of capped it in a sense at 100,000. And I'll kind of explain why. We over-raised very quickly on my investment. So the fractional process, let me start sharing some slides. So the first thing you're going to want to do, whenever you have an investment, the very first thing you want to understand is what are you offering to your partners? Are you offering an equity opportunity, right? Are they coming in and are they co-owning the investment with you, right? So they're going to benefit from the risks and the profits from that investment. So what if it does great or it does even better than you anticipated? Everyone makes more. If it does worse than you anticipated, well, then everyone gets worse returns than you originally projecting. Whereas if it's a private money lender, this lender slash JV borrower one where people are just collectively pooling funds. I mean, it's no different than PML and PMP, right? Your private money partners are investing with you and they get not only the cash flow, but the ownership benefits. If the property underperforms your projections, they get less returns than anticipated. If it overperforms, everyone wins and everyone makes more money. With a private money lender, regardless of your property performance, if you're not paying them, there's inherent risk that you're defaulting your loan and they could take that investment from you depending on how you structure that. The only difference now is you can bring in more people at lower dollar amounts, right? So whenever you have your investment, I guess the first step is having your investment and then choosing your deal structure. Then when you go on the fractional platform, it's imperative that you are able to pitch your vision. For me, like they've talked about a variety of options on there where you can do like what Pace recently did, where he's raised money for a buy box. We're going to go raise $1 million to go buy these types of deals. Or you can raise funds for active deals that you have that need to close. For example, what I just did on my capital raise. I did it the way that I did it, where I raised funds for active projects as a proof of concept to say, okay, well, does this make sense that either I can raise funds in a short time frame in the future if I need to through multiple partners, or do I want to raise 500,000, $1 million the way Pace just did to then be able to go find investments? For me, it's co-living rentals, right? Co-living rentals, RV parks, things like that. Do I want to pre-raise funds so when the right investment comes in, we can pounce on it immediately because we're liquid and ready to go? But I wanted to feel confident in the process first by working on active deals, not just raising a bunch of money and then sitting on it for a while. Pace has so much deal flow, it's not much of a concern. Right now, for me, for example, start raising capital for 2 to 3 RV parks can always increase my deal flow for co-living rentals. So looking at more of those as well, of course. So then the idea is you are pitching your vision on the fractional platform. So you create your community, your group, whatever, and you are pitching your vision. What is your mission? What is your track record on your past deals? Share your research and underwriting, de-risk your investors, and explain your timeline. Basically, like, what are you looking to accomplish? Either you A, have your project that you're going to raise money for, like I did, or B, actually Pace did that too, right? He raised money for projects that he was fixing and flipping actively, and then now is doing kind of that buy box method where he says, hey, this is what we're going to do with that money. We want the money available. This is the vision for that capital raise. This is what we're going to do. It's a lot easier to do that with private money lenders because no matter what, as soon as their funds hit, in theory, Pace should be paying them 12% return on their money. I don't know if that's the way his is set up. It could be set up anyway. But in theory, once the capital is raised, you're getting interest on your money. When it's a private money partnership and you're raising a bunch of money in advance, well, you're just saying, hey, we're hoping to find deals like this. I've seen people do that on there. I know they've had a hard time raising capital because it's kind of hard to forecast what the ownership returns are going to look like just based on a bunch of assumptions. Hopefully that makes some sense. All right. So once you have your like vision and your event set up, and we'll go like into detail with my stuff, right? Once you have that set up, they call it herding the cats, right? This is when you know how much you're going to raise. Here's Alexis Morgan. Many of you are familiar with her for a project that she was doing in Georgia. Once your investors say that, yes, I want to be part of this, then they commit by putting in a deposit. Basically, it's refundable up to a certain point or something like that. Stella Hahn, the CEO of Fractional, will go into more detail with this for you guys anytime that you need that. But I believe their earnest money deposit or the deposit they put in is refundable, or at least that's the way I set mine up. It doesn't always have to be refundable. For me, I said, hey, if someone puts in, I think if the capital raise is, I want to say it's like they do like 10% or 5% is the deposit. So if they're doing $25,000, then they have to put in like a 10% deposit or something like that. So 2,500, or maybe it was less than that. Maybe it was a 1% deposit. I don't know. Or a 2% deposit. I think it was a 2% deposit. So maybe $500 deposit. And then that can be you as the capital raiser, you as the borrower can say, hey, either once they commit that, we're going to keep it regardless. Or you can do what I did and say, hey, I will refund that. I don't care. Like if they decide to back out, I don't want to work with them anyway. Not in like a rude way. I just never want to partner with someone long-term if they're on the fence. Let's just work with the people that want to work with me long-term. It's kind of the way I think about it. Once that process is going and you are building up your capital is being raised, then you are doing follow-up and communication, both with the people that have raised funds, kind of keeping them track of, hey, this is what's going on. And then people that you're still adding more, you're still making sure your deal people are continuing to commit the capital that you need to hit your goal. I don't fully know what it looks like if you are not able to raise the capital, right? I'm giving you my experience. If you're not able to raise the capital, I don't know if it's everyone gets their money back and no harm, no foul, or you can move forward with the project. Let's say you raise 100 instead of the 150 here. I don't know. Maybe you can move forward with 100. I don't really know what that looks like because we raised all the capital. We raised way more than we needed. I was raising 675, which included all the fractional fees and all that. And then we raised over 800,000. So that wasn't something I dealt with in my capital raise. And then as you continue marketing and sharing, this number, like this, actually, let me show you. So Stella made this post, and I'll show you a few posts that I made. As you see those contributions being made and you want to be part of this deal, right? It's like, oh crap, there's only 100,000, or there's like 600,000 of the left. There's 500,000, 400,000. Oh my God, if I want to get in, there's going to be some level of urgency and FOMO. And it's not even intentional necessarily, but I'm sharing with you some of the capital raising process that I did before I mean, actually, let me get back to this because this is so good in the right time frame. I'll get back to this. Let's go through the overview and then I'll show you my actual examples because I can go back and forth the whole time. Oops. So the cool thing is that not only is fractional there to help you raise capital for your investment, the reason why I utilize them was not just because of the capital raise ability to be able to raise money in small increments. That was cool, but I honestly could have raised the money from 2 or 3 partners anyway. I didn't need to have 26 people originally deposit, 20 people finally commit and like be part of the deal long term. I didn't need to do that in this capital raise. I knew this was a great deal. I could have raised it from 2 to 4 people anyway because of I'm always networking, right? You want to know how I raised all this money in a short time frame? It's not fractional. It's not any of this stuff, right? I've continued to share my story and be valuable to other people, share resources, help out people out in my journey, let people know what I'm doing consistently, have a systematized way where people who want to work with me as capital partners can go in through my form into a CRM. And then when I have capital to raise, we let them all know this is what we're doing. I've built a community, some social media presence. I'm active in Owners Club and Sub 2. That is really how we raise this capital. And that is how I knew I was going to be able to raise the capital even without fractional. But the benefit of fractional is not just the capital raise, allowing 20 people to partner with me on one deal without worrying about SEC laws and all that. Don't ask me why. Ask fractional why that's cool. But really for me, it was because they were going to help overall make it easier for me to have more than 4 partners on a deal and with a lot of the operations and like administrative stuff that I didn't really want to do with 20 different partners. And so what does that look like? Well, they set up the LLC and the operating agreement for the capital partners. That's all done through them. They set that up and make that nice and easy for you. You basically structure the ownership percentage. Let's go to this. So I have something called my property acquisition blueprint, and it's something I train on. And essentially it's like the 15 steps you do over and over again from very basic of getting a lead to then making sure it's an actual deal and all the way to closing, bookkeeping, operation, whatever, all that good stuff. Well, within fractional, when I saw not only do they help with the investor relationship management, because you can create a community on there, you can start connecting with people who are on the platform, you can bring your own capital partners on the platform. People can also put the money directly in there, which is cool. Instead of me having to coordinate with 20 people to fund those deals and like, hey, 20 people, make sure you have your wire instructions, do all that. Fractional's team does all that, which is great. They help with the capital raising, investor relation capital raising, with the overall business plan, collecting the commitments, getting everything funded, signed, verifying the investors, which is awesome. But then they also do like 5 of the 14 steps for me. And we'll go into the pricing. That includes setting up the LLC for all the capital partners, setting up the operating agreement for the capital partners, the EIN for the capital partners, the LLC bank account for the capital part, or for the investment itself. They handle the bookkeeping. They handle the tax filing and K1s. On the platform, you can do all the investor payments. And if you need to do capital calls, let's say you need to put more money in, or people need to put more money in, potentially. It's not ideal. You do not want to set up your deals where that's a necessity, but you can do that through the platform, all through that bank account. You're paying your investors. It's all done through that. When you're communicating with your investors, this one's huge for me. When you are communicating with your investors, I don't have to figure out, okay, are we going to create a Slack channel, a Discord channel, text group, emails? Like, how are we going to communicate? It's all done through the platform. The main reason why I really loved the concept of using fractional was not just the proof of concept, to be able to raise larger amounts of money through smaller, like fractional ownership with partners and allowing more people to get in on the deals and take advantage of those ownership benefits, not just the cash flow, the appreciation, debt pay down, and taxes. That's all cool. But like then 20 people now, instead of 2 or 4, can actually leverage that on their own investing journey. Right? They can say, hey, I am an owner on $2.2 million of co-living rentals now, and they can leverage that as they then go and find more deals and raise money and all that. That's making them better, more well-rounded investors with more credibility. That's what I really loved about this. And they're going to massively simplify my ability to oversee the management of my investment by doing a lot of these freaking things. I don't even know if they have this broken down anywhere outside of what I had them work with me to create, how this is in alignment with my property acquisition process and some of the things they offer, just like seeing, wow, you guys solve 8 of the, 15 steps that I talk about regularly. So let's talk about, for all of this, like what is the pricing, right? Let's focus on that. And then I'll tell you some insights about where I think it makes sense and where I don't think fractional makes sense. So the pricing. So when you are doing your initial capital raise, right, for my $675,000, whatever that amount was, they take 2% of the property price, or the capital raise, not the property price. The capital raise is what they get That'd be crazy if it was property price. We need to make sure that's not the case because that's not what they collected from us with a minimum of $3,000, right? And I'll explain why this minimum is incredibly important, like incredibly important when I determine what deals kind of make sense for this or not. The reason why I did it for my huge capital raise is yes, I'm going to pay them more. I exceeded this minimum amount where like 2% was higher than this minimum amount. Basically, when you're above $150,000 capital raise, you're paying like the fair 2% price. Anything below $150,000 capital raise, your percentage is actually much higher than 2%, right? Because you're paying that 3K either way. So if you are raising $100,000, you're not paying $2,000, you're paying still $3,000. So it's now 3%. Raising $50,000, you are paying not 2%, you're paying 3K, which I don't know, whatever 50 divided by 3 is. You're paying 3 divided by 50 is 6%, right? You're paying 6% of the capital raise. So it starts like the lower the capital raise, the worse it is like financially as a percentage of the capital raise. Anything over $150,000 is the same as a percentage. For all that, they'll create the LLC, right? You leverage their platform to raise the capital, to create the LLC for the capital partners, the operating agreement. They'll do all the dirty work of the capital raising piece. You have to still raise the money, get people to go on there, commit on there. But once they commit, Fractional handled all the rest for me. I didn't have to follow up with anyone and verify, hey, did you do this? Did you deposit your funds? Have you, wire them? Did you using your self-directed IRA? You going personal? I didn't have to do any of that stuff, which was awesome because that freed up a lot of my time to focus on other things, which is great because if I had to do that with 20 people, I would never do that with 20 people. That's why I typically do capital raises between 1 to at most 4 people. It's just not worth all the headache of bringing on more people. In this sense, they allowed me to conveniently bring on more partners, help more people get into their first deals at lower dollar amounts, 25K minimum for me. And they handled a lot of like the dirty work that I would not have wanted to do with that many people. Not only that, you can pay them a recurring annual service fee, which for me makes a lot of financial sense. This is new. So it used to be $2,500. Now they have it broken into different, I don't even know what they're going to charge me for. I might be grandfathered into the $2,500. We'll see. But they will cover a lot of additional tasks for you. For example, I can communicate with all of my partners, 20 partners. I don't have to do 20 different emails or a group chat with 20 people. We can all communicate on our community page. They set up the business bank, which is whatever, right? That doesn't cost any money. Once you have your LLC, you have your EIN, you can set up your business bank account. That's whatever. But the business bank account is incredibly important because then through their bookkeeping, you can automate profit distributions and capital calls. If you can do the profit distributions and capital calls of money in versus or money out to partners or money in if you needed to. Please don't set up your investments where you need to capital call your partners. Like it happens, but like have reserves on your investments. So like that's not a thing. We had over like 15 to 20% reserves on on this investment. That's part of the reason why the capital raise is so high. Part of that was there were still plenty of variables as part of the capital raise with coming refinances and finalizing terms and renovations still not being fully completed and furnishing, like whatever, there's still variables. The last thing I wanted to do was under raise and ask for more capital. I'd rather over raise and then figure out with my partners, what are we going to do together, or just have solid reserves on the property or on the investment. The idea was the numbers were still based on the initial capital call. So if at minimum, we just put that extra capital in a high yield savings account, everyone's returns that we anticipated would be higher overall just because of that extra 5% return. So I decided to give up more of my equity to have more reserves and still get my partners returns that they wanted or that made sense for them. But then also know like, cool, I am basically already accounting for the worst case scenario. Best case scenario, we all win and we do better than we anticipated. Yes, did I give up potentially more equity than I could have? Sure. But I'm also understanding, like I'm always grateful that I am in a position in which I am getting infinite returns on my deals through sweat equity. I'm finding deals, I'm analyzing them, I'm doing all this capital raising, all that. At the end of the day, it's not my money, it's my capital partner's money. So if I end up getting them better returns than we anticipated, awesome. I'm not sour about that. Could I have given 35% instead of 40%? Sure. I'm not overly upset that I gave up more returns potentially in that scenario than I could have otherwise. All right, back to it. So they will do mortgage, insurance, property tax management, and payments. Like you can do that. The bookkeeping, I don't know if you pay for a bookkeeper, but my bookkeepers cost me around $300 to $350 a month. And I have 2 to handle my personal portfolio and my coast-to-coast vets portfolio. So that $300 a month is for multiple properties. But let's just say I'm paying $50 a month for bookkeeping, right? Which is very much on the low end. That's $600. That eats into this $2,500 cost. The tax filings and K1 distributions. Well, it cost me like $1,200 per property on the low end to do these K1s and tax filings. Well, that's now $1,800 of costs. Compliance for the LLCs, that's more costs. All these things are basically like eat into this annual recurring fee. Like it basically pays for itself through that. And you get the convenience of being able to do that through their platform with a third party, more transparent, and the page to communicate with your investors. What I mean to say is, at least with the $2,500, it's very easy to make the case that the cost you'd be paying outside of the platform is roughly what you'd be paying on the platform. And they just make it more convenient because they do a lot of it for you, which is awesome. For anyone who deposited 25,000, they're invested 25,000, $500 deposit. Perfect. They have this other higher tier if you do more for these concierge services. I don't know. For me, this is like my job, right? As the investor, I better do the property underwriting. Like we need to get the insurance quotes. I don't know. I don't need a third party to do that. Property management, all that, but that's me. For you, it might be worth it. So that's another option. They provide those additional services, more like concierge, handholding, provide you more, I don't know, info. For me, it just didn't make financial sense to do so because we already had a lot of that stuff. I don't think deals that you're raising less than $150,000 are worthwhile to utilize fractional. Like, I just don't know if it's worth it financially, but it might be for you. I don't know. A big reason for that would be maybe you cannot raise the funds through an individual or 1 to 4 people, and you need to be able to allow 10 people at 5, like you're raising $50,000. Yes, you're paying 6%, right? On that $3,000, 6% of that. But maybe for you, it's easier for you to have 10 people that each put in $5,000 as opposed to finding one person that does $50,000 and not spending all these extra costs. I don't actually know. But from a financial perspective, anything that's less than $150,000 capital raise, I just don't think makes a lot of sense to raise through the fractional platform, especially when you account for like the $2,500 recurring cost. That is an option. You don't not have to do that, is my understanding. But if you're doing a property that's a low capital raise, it doesn't make sense for the setup fee. So if your capital raising is less than $150,000, and you're not at least underneath this 3K, you're not getting the 2%, like $150,000 is 3K, right? Hopefully that makes sense. I'm articulating this poorly, but I think capital raises under $150,000, it doesn't really make sense to do on fractional just from a financial perspective. It could be beneficial for you if you have a hard time raising capital in smaller increments or in larger increments. So you might need to pull in 10 people for, 100,000, 50,000, whatever. But just understand you're paying a larger percentage of the funds raised as the fee because there's the minimum fee. Secondarily, if your properties are not cash flowing very well, then it's really hard to raise a solid amount of, it's going to be really hard to cover this service fee, this annual service fee, if you choose to go that route. So like low cash flowing assets don't make a lot of sense unless you and your partners understand, yes, that's just a fee you're going to have to pay for, or you do what I did, which I just accounted for the next 5 years of service fees and the setup fee. That was part of my capital raise. So my partners and I, we didn't raise these funds and then we lose cash flow as a result of not having these funds set aside. That was part of the capital raise. We set up, part of the capital raise was this 2% fee. Part of the capital raise was the next 5 years of these service fees. It's not going to affect our cash flow on this investment because I didn't underwrite it that way. That was part of the capital raise that then would not impact our cash flow. Everyone gets to cash flow that we discussed, and we're just leveraging the balance sheet or the capital raise, right? The reserves up front for those costs. It just pre-raised up front. But if you have low capital raise or you have low cash flow or you don't have these funds set aside, you're just going to eat in massively to your profits for these things. You have to do that already, but now your partners are also eating into their own cash flow. Whereas usually when I was raising capital separate from fractional, myself and my business were covering the bookkeeping costs, the overall business costs. The things that we were splitting with our partners was tax filing. But we covered the cash flow cover the compliance. It's nice here because we know what the dollar amount is, and then they will just do all of that for that dollar amount. So why did I select fractional for my capital raise? To be transparent, I could have raised the 800 or, really it was 675. We raised way more. We returned a bunch of funds because people just kept depositing when we were already passed. However, for me, it made a lot of sense to go this route instead of raising the funds through 1 to 4 people because it was an awesome investment opportunity. 100% 5-year return, which is 20% annualized return, total ROI. Cash flow isn't phenomenal on this one. It's closer to 6%, but because we're walking into 2 fully renovated properties, recently appraised solidly, walking into over almost $500,000 of instant equity day one, or $400,000 of instant equity day one. We have very little appreciation that we're modeling out. We have solid reserves. This was a great investment. I could have had 1 to 4 people fund this. The reason why I chose to go the fractional route was because I wanted to conveniently, right? I wouldn't have done it if it wasn't convenient just because I'm trying to grow my business. I can't cater to everyone else and provide 20, 50 people potentially as partners if fractional didn't exist. So I chose to go with fractional because I could bring on more awesome investors who share the vision of co-living, affordable housing. Let's buy and own these assets together. And because of the investing club model that fractional offers, which is why we're able to avoid like SEC regulations, is my understanding, I could bring more partners more conveniently, which then helps more of my partners on their investing journeys. Not only are they getting solid cash flow, ownership benefits, they're also getting the story, the fifth benefit of real estate investing they can leverage for their own capital raising, for their own deal flow, for their own credibility, for their own social media, for their own marketing, for all of those other benefits. Like I wanted more people to be more owners so that they can accelerate their journey. Part of that is my community of super investors. I wanted more super investors to, if they wanted to and have the capital, to be able to own these assets and leverage that for their own credibility, in addition to other partners who are also feeling the same way, that they would love to leverage the credibility and the extra education and knowledge that I'm providing as part of this investment opportunity. Fractional allowed me to, because we could bring on more partners, is a lower barrier to entry. So more partners could come in, is more accessible even to people who have less capital. For me, I made the requirement 25,000. I didn't want like, 100, or is that right? Like 100 plus properties at partners at 5K each. But 25K seemed like the solid low enough amount for the ownership benefits that were involved with it. The other reason why I use it, they streamline the process overall. Their infrastructure, what they offer on that platform, reduced my time and the complexity of me having to structure the capital raise and doing all of the ongoing process of the capital raise and the ongoing ownership, like tasks involved, like I mentioned in what I show here. And then let's go back to this. Like, because they're going to do a lot of this, it's going to free up my time. Then it made a lot of sense because they streamlined my process for me. And then another reason why is now I have this awesome, when you go on fractional, you see Michael Manaskyan raised $820,000 on his $662,000 of capital that he was looking to raise on the fractional platform. And fractional platform, yes, it's a lot of people looking to raise money, but there are also people there just looking to lend and invest on other people's investments. So now I get access to this investor network that sees my credibility, my proof, and that other people, that 20 plus people have invested with me on this investment. So then it's going to make it easier for the next one as well, if that makes sense. I also really like the way that you can structure your, like, so we'll go into all this, that you can structure your slide deck this way, as opposed to the typical like presentation that I do, the slide deck that I do. I like my slide deck, but I really like the way Fractional has it here, and that people could instantly deposit funds right through a click of a button instead of waiting till the finish line and then them having to wire the funds, right? So I like that they can put their capital in up front. That was another awesome thing. Okay, once again, I don't want to like make it seem like, oh, thank goodness for fractional, because if fractional never existed, I would never be able to raise money. I already have the ability to raise the money. I'm not saying that as a flex. I'm saying that for you to be realistic, because if we go, and I'm not saying this to be rude to people, but if we go, I still have a hard time understanding how to fully use Fractional's website. But if we go so if we look at just projects, right? So this capital raise, they wanted 650,000. They've raised 10,000. Pace, of course, raised $1 million. A lot of this happened this last day. This one, it says Pace, I guess, was trying to raise 172 and raise 90. This one, I know this guy, Trevor, was trying to raise like $500,000-$600,000 and changed it over and over again to then meet this criteria. And even then he closed it at a $308,000 cap raise out of 365. Heather, working with Pace, right? 170 out of 190. I'm saying all this to say, like, they're not just like some magic thing where there's just so much money flowing around, everyone and anyone can just like crush it and raise money. It's more to it than that, right? The Fractional is a great tool, a great platform, but it's not like there's just like millions of dollars being ready to be deployed into your assets. What really allowed me to crush it with my investment was sharing my investing journey as I continue to invest, right? Not from the very beginning. When I was active in the military, I was pretty shy. Actually, I really started sharing my investing journey the last 2 years when I joined Sub 2. And even then, it wasn't very public. It was more so in the Sub 2 community. So first, people had to know who I was, right? You have to share who you are, what are you doing, as you continue to do more, as you continue to learn more. I remember when I joined Sub 2, I was doing a little bit of creative financing. I was wholesaling a bunch of cash deals. I owned various properties, and I've done some creative financing and all that. But I was really getting knowledgeable about like Sub 2 and wholesaling creative deals and all that. What I was doing is I was making really intentional, value-driven posts to just provide value to other people as I was learning. Something I talk about all the time to super investors is the best thing for you to do is to just share what you are doing and what you're learning, allow people to get to know you, not just from like, hey, I just closed a $820,000 capital raise, but like, hey, I've just analyzed this deal. Here's 30 minutes of me analyzing this deal. Here's why I don't think this is a great investment for me. Or, hey, here's how I'd make this a great investment. Or, hey, I just learned how to determine the cash on cash return, or like what are the best levers to pull on a seller finance deal to generate high cash on cash return, or whatever you're learning. You got to share that. People got to know you. That's like first and foremost. Then you have to start building this somewhat of a funnel for capital raising opportunities. So like this is the first step of my capital raise process. And I know you can't really see, I'm sorry, I have a very simple form that when people are interested in working with me as a potential capital partner, right? Going into Facebook groups, people want to hang out or talk, you going into the Zoom calls, you're exchanging contact info, you're saying, hey, here's what I'm doing, here's what I'm looking to accomplish. I have a vision and I'm sharing that vision and seeing who's in alignment with it. The first step is if they're capital partners, they can simply fill out this form, which then puts them into my CRM and my workflow. This very easily then allows them to schedule time with me so that we can get on a call and I can learn more about who they are as individuals and what are they looking to invest in, right? And it's streamlined for me. That then goes into the CRM. And then when it's time to raise capital, I can then blast it out through the CRM and say, hey guys, this is the investment that I have. Here's my slide deck for it. Here's my analysis for it. Let me know if you're interested in this investment opportunity. So by the time this capital raise occurred, I have over 300 people in my CRM that are potential capital partners that have expressed interest. I have a community of people that I educate in real estate investing. I've been sharing my journey for years. I'm saying all this because you need to share your journey, share your vision, and find people that are in alignment with that. And then make sure you have a way to keep in touch with them so that when it's time to raise money for a deal, you can do so fairly accessibly. I wasn't planning on going that route, but I just want you guys to understand that it's one thing to like have the platform. It makes it easier. I don't know what's international investor angel. Oh, would this work for an international investor? I don't know. Ask Stella Hahn from Fractional. Mike Van Maren, do you think a person can get the needed funds without the network and brand that you have created? Potentially, right? Like, I don't know. I can't tell you. You're going to find out. First is this database of potential capital partners, building your brand and this database of capital partners. Next is having a phenomenal deal that people actually want to partner and invest on, right? That's like phase one, phase two, and then like funneling them into that deal. That's really the big thing. Fractional made it much easier for me to funnel people into a specific platform to see the deal and all that good stuff. So Mike, I mean, obviously it's possible. I did it without having a brand and all that stuff first. That's why I'm telling people now, Owners Club, super investors, sub 2 people. Well, I guess that's not anyone in this call, right? Share what you're doing, share what you're learning, add value to people. Pace has created a community of over 15, almost 16,000 people that are in sub 2 alone, 100,000+ in the free Facebook group. You have access to Instagram, Facebook. I'm not saying try to do all of it, but like share what you are doing. That's foundational. Otherwise, no one's going to know who you are and why would they want to work with you. Then you have to have a great deal. Then you have to actually present that deal in such a way that people want to partner with you on that. And I will show you how I was able to do that through Fractional. All right, let's move on to the next area. Okay, so with all that being said, right, the reason why I was able to raise this in 72 hours was not because of Fractional, like solely. Fractional was a big part of it because I wouldn't even be able to talk to enough people or get people to actually deposit their funds or then do all the back end without Fractional. So Fractional solved that third piece, which is presenting the deals and then getting the money flowed in a very systematic way. So to give you full context of my timeline, which is not recommended, I needed to wrap up my capital raise and all that by the end of February. Well, the problem was I was in talks with Fractional on February 11th, and I didn't know what the typical process timeline would be for that. They usually prefer several weeks of leeway between the time that you start your capital raise, close your capital raise, and then after the capital raise is done, to then be able to get all the LLC, like they have to set up the LLC, set up the bank EIN, get the EIN number, get the bank account set up, do all of this stuff, fund the banks, transfer funds, all that stuff. So I didn't know that when I was starting, unfortunately, with them. So when I started, I had a call with them on February 11th saying, hey, this is what I'm looking to do. They said, whoa, well, if you want the funds by the end of February, it might not be possible unless you are able to raise all the funds by the end of the week. I said, well, that's crazy. I've never raised that much in one go. How am I going to possibly do that? Well, regardless, back against the wall, I made it happen. And this is basically the process. So February 11th, had the call with them. February 14th was when the capital needed to basically the majority need to be committed to move forward with the refinance and the next steps of the renovations. So starting that same day, I started building out the project outline on Fractional and started sharing teasers on social media of, hey, this is coming. Even with just an outline, I started sharing, hey, this is coming. If you want to co-own 25 co-living doors with me, then this is coming up. and you could get into it for as low as $25,000. I started doing that. I can't really show that, but I can show, here's the first ever thing. I wonder if it'll actually show. Oh, cool, it will. So want to learn more about how we can own 25 co-living units together for only $25,000? Join me Thursday evening from 5 to 6 p.m. PST. Register using the link below. I created the basic outline of my fractional. Actually, the first thing I did was create the event. I said, I'm going to host this call. Then I started building the project out on fractional, right? This is the project. This is building the project out. This is right here. And all I did was I looked at what other people were doing. I had no time to reinvent the wheel. I saw kind of the basic structure was overview. For me, it was very imperative to highlight the investment returns for my partners. If you know anything about me, you know I pride myself in the ability to analyze deals effectively and then be able to share those returns to people, not just the cash flow, but what are the overall ownership benefits? And then the big one now is, guys, I gave you the secret, right? How can you get more from this investment than just the returns? And I highlight that through all this. If you want that, I'm going to drop that in here so you can actually look at this in real time later. You can follow along, whatever you want to do. That's in the chat now. So that's, yeah, who am I? Like, what's our business info? Since we're going co-living, explaining what pad split is, co-living. I didn't reinvent the wheel. I just looked at what other people were doing and then got that. They had a risk analysis and mitigation strategy section. Cool. I answered that. I basically crafted this around that. Then the investment properties and financials, this is where I dominated compared to most because they were very basic on what they were sharing, or was a lot of projections or theory or what. It's like, cool, well, let's go into real numbers as best as I could with variability. Let's go into as much real data as we can, how the opportunity was going to look. And then for me, the analysis. If you want to know, if you want to see the investment analysis, it's in here. If you are not on fractional yet, you can sign up for fractional. If you are on fractional, just click that link and you can grab the investment portfolio analysis showing you the actual numbers. I'll quickly share that. This is the investment analysis right here. So you can see all that, the projected returns, right? And then highlighting that because I'm the type, and this is what I really highlighted, you guys are going to want this video. This video is the actual capital raise presentation. There's no point in me going through it right now. This is the capital raise presentation, then put on YouTube as a video. So I just dropped that in the link as well for you guys. I break down the fractional fees and then I highlight that the part of the capital raise was accounting for that. So it's actually 675, but then the 13K was the 2% that I owed them or something like that. So then they changed it manually to the 662. 675 is the actual capital raise, but $13,000 of that was going to fractional for me, them doing all this work on the capital raise process. All right, so you can go look at this in real time. You can go do that. So 211, I built out this event saying, hey, let's own co-living rentals together, right? Then I started sharing on social media. Here's one example, right? I showed you the Instagram post. I'm a stories guy. Like I'm really suck at posting, but stories. And then another one, if you could have ownership of 3 real estate investments with over 2.2 million, get cash flow and ownership returns and instant equity, learn co-living management strategies. Would you be interested in learning more? Doing a live webinar tonight. Like literally, this was all happening in real time, right? In my community on 212 Super Investors, I did a preview call the day before, kind of high level, going over the info. Some of my super investors are partners on this deal. I'd say maybe a third of the capital is from my community. A third of it is from people from my capital raising database. And then a third of it was people who saw it through social media, through the post that I made on Sub2, Owners Club, people that I was not necessarily in my form or my CRM, but they invested in the deal during or after the capital raise presentation and or YouTube. I can't necessarily say where all of them were. I haven't touched base with everyone yet, but a big part that was surprising to me was that people who were not in my CRM were also partners. And the few people that I did touch base with afterwards that I've never talked to before, they expressed I was so thorough in the breakdown of the deal and the analysis. They were confident. They wanted to learn more at minimum. They wanted the returns, but they wanted to learn more from me and how they can do something similar for themselves, which was freaking awesome. So just sharing like the analysis piece was a huge part of it. And going and like watch that video. All they watched was this one video, and that's how they made that decision. And if you're not subscribed yet, please subscribe. I just got over 500. I'm very much intentional about social media now, so please do so. So there was that one. So 213, the fractional project went live on fractional. And that was literally, this was like basically in real time. Once again, this was during the call. I think we had like $600,000 raised or like over 500,000 during the freaking call. It was like wild. It was insane. And that's the cool part because I would not ever know that otherwise. Like I wouldn't be able to know that necessarily without a lot of back and forth communication with capital partners. Fractional people can just deposit their funds right away. It's incredible. So then literally, what is this? So here's 620. So this is that like urgency, I guess. It wasn't like intentional, but basically hey guys, we're basically done raising capital for this deal. This is your last chance to invest. If you want to, go to the platform. I don't know. So this is 3 weeks. I wish I had the dates, but this was like immediately after, like shortly after we over-raised the capital on this deal. We then over-raised the capital on this deal. So this was 620. So what I'm saying is you got to build lead flow. You got to have a great deal. You got to present that deal effectively. Then you got to, as you're growing the capital for that deal, share that, because that intentionally or not adds a level of urgency to people who wanted to invest in you, but were kind of waiting on the sidelines. So me sharing this stuff was like, holy crap. And this also builds your credibility when you're raising more capital for the next deal. One of the most important things to do when after you're done raising capital is say, hey guys, just as an FYI, we just raised all the capital. I didn't do that for the majority of my capital raises, but when you're raising money and people are funding those deals, and then you confirm with your partners, sorry guys, for anyone else that's interested, we've already raised the funds. That is a great way. So then they will take action more quickly in the future. I made this one post here. I made one post in Owners Club. I made 1 or 2 posts in sub 2, and the sub 2 stuff got removed, unfortunately. I don't even know what the rules are anymore in sub 2 about capital raising. But basically, if you want this, you can go check it out on my Facebook. Basically the same things that we talked about. I just leveraged the work that I did in here. I just leveraged that to then create a Facebook post highlighting some of the reasons why someone want to invest, but catering it more towards like a general Facebook audience, saying, hey guys, come to this call. And then once again, 211 started the capital raise, or built out the fractional page, started sharing on socials about the event on 213. During the call on 213, raised 90, like 70, 80, 90% of the capital. And then by 214, we were fully funded with excess capital raised, which I didn't even know was possible. I did not know you can raise way more money than you need to. What we did was just redistribute or ask certain partners to lower their capital contribution so more people can get in, which is great because there was several people that really want to be part of this deal. And we were able to get them in by asking others to lower their capital. So continue to share your story, build this database of capital partners, have great deals. Fractional help by making it much more effective for them to be able to invest in those deals, to have this event there, adding that level of like sharing what you're doing actively, adding that level of urgency by sharing like, hey, we're just raising this capital. You're not doing it like as a marketing tactic, but you're just saying, hey guys, the capital needs to get raised. We're already basically funded. If you want to, like if that is your situation, then come on, let's get it going. Having a professional presentation. So in that YouTube video, but all I did was basically share this short intro, who I am, what my business is. And then all I did was go through this, go through the deal analysis and the spreadsheet, and then answer questions. That was the process of the capital raise through that one event. And then take that video, post it on YouTube, and then share that with people who missed it, right? So the people that signed up and missed it, they got access to that video, or people in my CRM, hey, I know you missed this, so here's the video if you want to watch what that looks like. And then I'm not going to go into my deal that's already in the video, that's already in the YouTube video, it's already all here, like why this was a great deal, why it was attractive. Like I can high level, right? The structure of the deal was 40% ownership for a $675,000 capital raise. We raised over $800,000, $820,000, either returned or reduced people's contributions to make sure more people could be part of the deal. The reason why I believe this was very attractive was, yes, it was solid cash flow. Even with a really high capital raise, a lot of the capital was set aside for reserves, strong market fundamentals in Atlanta and Savannah for co-living and rent by the room. And there was a lot of equity built into this investment. So a lot of this return isn't necessarily cash flow. Cash flow is a component of it, but there's a lot of ownership benefits that come with it as well. And then the commitment to educating people. But I basically am offering like an education, a mastermind, something along those lines, depending on how much people contributed at an upcoming event. Basically, Owners Club workshops and all that stuff. I'm providing that as a resource to my partners so they can not only be part of this deal and get the returns, but they can leverage this for their own benefit to be able to buy and hold more real estate, raise money from other people, all that good stuff. I think it was also attractive because it was an ownership opportunity, not just a private money lender. I am very heavy emphasis on deal analysis and articulating that although there's still unknowns, I broke down in extreme details what those are, what can go up and down, where I'm being more conservative, where I'm being more, maybe a little more aggressive with some of the analysis. So just sharing like the good and the bad of it all. And then once again, leveraging my network, leveraging solid deal analysis, having a compelling deal structure and a deal overall, and then leveraging the fractional platform to then raise this money. I shared the pre-launch marketing, it was all done within like a day or two. CRM, right? Sending emails out through my CRM, social media, Facebook and Instagram posts, and then making up to 3 posts between Sub 2 and Owners Club collectively. The live webinar was a big one. So hosting that interactive session, creating that into a video, or like recording it, putting it on YouTube for anyone that wanted to watch it. It's crazy because it's like, how many views was it? It was not even, the video itself had 210 views, which in reality is not a lot of views, I guess, to most people. But that means 210 people spent at least up to an hour and 21 minutes watching this video. And those that were serious investors and wanted to actually partake in this deal, I don't have to explain everything to them all over again. I didn't say, hey, go check this out. Here's the video where I break everything down. If you're interested, here's how you do it. Go to this link and you can just literally deposit your funds. And then just transparently providing the updates as we were getting the deal funded. Yes, it benefited from a level of urgency, and then the momentum of it. Like people want, it's like when Bitcoin goes up, like Bitcoin's, I bought Bitcoin at $5,000, $6,000, but it's like when it gets close to 20 is when everyone wants to invest. Or like recently it was like everyone wants to invest when it's at 100,000 when they could have bought it for less than 50,000 a month before that. And then it goes down to 80. Everyone's freaking out. People FOMO and invest because they like the momentum of it as a part of it. I'm not saying go like crazy on that, but I'm saying if you are actively doing it, this deal is getting funded quickly. Make sure people know that. And the people that were on the fence will more likely take action because of that. So the post-raise process, and I'll answer all these questions. I see questions, I'll answer all of them. Once Fractional finalized all the investor commitments, made sure everyone was ready to fund, they were setting up the LLC, setting up the EIN, setting up the bank account, confirming wire instructions, funding instructions, whether you're self-directed IRA. So my capital was deployed in 2 increments. One was people who had funds that were ready to go and personal funds. And then the second one was self-directed IRA capital, which actually just hit yesterday. So all of this was raised a while ago. The self-directed IRA funds were just wired yesterday or maybe even today. And then everything else was wired before the end of the month. They created, like I said, the LLC, all that stuff. Then the LLC, my capital partners, Super Split LLC is what Super Split 1 LLC is my capital partners. Well, it's not that they actually are the owners of the property through the LLC that owns the property. In reality, the way that it's done on Fractional is that's an investment club. That investment club is joint venturing with my LLC that owns the property. I didn't know that. I didn't know that that was the way that they did it. Thankfully, Stella was there to articulate that during the call. And basically what they did is they created their LLC, my capital partners. I created joint venture agreements between the ownership LLCs and their LLC. My capital partners then collectively reviewed and voted on how they were going to revise it, if they were going to agree with it, and then sign it. And then the funds were dispersed. The majority before the end of a good solid amount before the end of the month in February, which was perfect. And then the remainder, like I didn't need the reserves, all that stuff. Cool. That's the self-directed IRA money that was there. And then I continue to provide ongoing investor communication. For example, let's see this. So this is the capital partners. I put this in there. Cool. Hey guys, there are some changes on this property. Like grateful. We just raised like all of them, like 700,000 40 hours. Well, here's some updates on the terms, right? I was able to reduce the interest rate for one of the refinances from 7.75 to 7.5%. What does that mean for our cash flow? What does that mean for our debt pay down and tax benefits? Well, because we actually then over appraised, I was thankful. I thought it was gonna be 125-ish. We've got a crazy appraisal at 1.425. Well, that means we all get a bunch more ownership benefit or a bunch more equity in the investment. However, that also means our taxes went up, right? The higher appraisal meant our taxes at that larger valuation was going to be higher. So we lost some cash flow. So just sharing updates throughout, then I have more to share. I keep track of all of that, plus events coming up. Hey guys, we're doing these meetups. Here's what's going on. All that good stuff. Catherine asked, is there any option for this to work with for referrals? Like if I know someone who has 20K and I recommend Jane Doe's deal, is there a way to, maybe you have to ask Fractional. I don't know. I didn't do that. I didn't have any connectors or anyone put capital into the deal. Maybe you can. I have no idea. That's a Stella and Fractional question. I'm sharing you my exact experience through Fractional, what I do know, and there's still plenty that I don't know, but I'm sharing with you what I have learned through this process and, some of the lessons learned and what has allowed me to raise the money so quickly. Next time can redirect them to your other raises. Thank you, Catherine. I'd appreciate that. I don't know how that works though. Like, I don't know what that process looks like. So Nadine, do you know if Fractional allows contribution for self-directed IRAs? Yes. We had at least close to a third of the capital raise come from self-directed IRAs. It took longer. It wouldn't have been an issue if I had a longer capital raise timeframe. But because I didn't know what their process looked like for the timeline, it worked out in our situation where, okay, cool, let's get all the funds that can be wired immediately. Let's get that done, move forward with the project. Let's not like wait, let's not pay unnecessary interest and wait on renovations. Let's just get the project going with the capital we have. And then the remainder of the capital that was self-directed IRA funds just hit like a few days ago, whereas the other ones hit almost 2 weeks ago or close to 2 weeks ago. So yes, you can. It depends on the custodian. They do all that back and forth. I don't have to call SDIRA or whatever, Horizon Trust or whoever else is providing these. I don't have to call them. They did all of that and they continue to update me throughout the process. What is the normal time frame fractional recommends? I don't know, because I was so like, let's just get this done right away. I would say like, give yourself, yes, I raised this much money. I gave a lot of caveats as to why I was able to and why a lot of people still struggle doing that. I don't know fully why, it could be a variety of factors, right? I'm an engineer. There's a lot of variables, right? So part of it was me and my brand. Part of it was the deal. Part of it was the video. I don't know how long it would normally take to raise as much money for someone else, but I do know that it took time. It typically takes people plenty of time to raise capital. And as I showed you, the majority of people end up not raising the capital that they wanted to. They end up raising much less, and maybe they can move forward or maybe they can't with that deal. But then once the capital is raised, then they want like 2 weeks after that point, roughly, to then set up the LLC, get the JV agreements approved, get the EIN set up, get the funds wired over, right? So they need most people will take a few weeks to raise the capital, and it'll take at least a few weeks to then get that whole process done. I just know when I started raising capital on the 11th, it was all like by the 14th, that 2 week timeline, if I had all the funds by the 14th, it was going to be a stretch to then get the majority of the funds by like distributed by the 28th. 2 weeks. But part of that was weekends and all that, but it would have been 2 weeks before I got capital from personal funds, even though we already had everything set up, primarily LLC, EIN, all that stuff took time. Then they can approve the JV agreement, and they can create the bank account, all that stuff. So it took 2 weeks for the personal funds, and then almost a month for the self-directed IRA funds. Is if we just go off of, I just got the funds today, and it's roughly a month after the capital was raised, a little bit less, like 3 to 4 weeks for self-directed IRA funds after the capital was raised, and around 2 weeks for personal funds. What is the deal structure? What was the purchase price? Okay, so Joseph, I love you, brother. It's all in here. All of it is in here. So the deal structure, I break it down intimately in detail. I have the video where I go through all of it. And on top of that, I give you literally all of this information. I did all this, not just like the reason why I also posted on YouTube was so other people could raise funds for their own deals and learn how I did it. Not just for me to be able to raise capital. We already raised the majority by the time I posted the video. I did that so people could also learn for their own future investment opportunities. But deal structure, 40% ownership right here. Minimum investment for them was $25,000, meaning each $25,000 investment was a 3.7% ownership percentage. This is the cash flow appreciation, debt paydown, tax benefits for a 5-year hold. And then at 5 years, we decide, what are we going to do with this investment? Do we carry on as is because it's solid? Do we refinance? Do we sell some of them? Like, it's 3 different properties. And we would vote for that. So that's all in here. We would vote for that. At the end of 60 months, members of the LLC will have the opportunity to receive their equity payout or remain in the deal for the long term and still retain their ownership percentage. So I give the option. Like I said, some people have different investing horizons. This one is a long-term buy and hold investment. So we were do no less than 5 years. Because yes, cash flow is nice, but then you get all the ownership benefits. One amazing example is I just looked at one of the properties I bought in 2021. It was around 3-ish% interest rate, FHA loan. So this was a house hack. So there's property mortgage insurance. But I've generated since 2021, let's say 4 years, I've generated maybe $50,000 in cash flow on that deal. I've generated another $30,000+ in debt paydown. I've generated almost $100,000 of property appreciation, and I paid virtually no tax on that. Like, it's great to have like these short-term investments, but when you look at real estate investing over the longer term horizon and all the ownership benefits, time is your best friend, because then your property, because then when you look at an amortization schedule, right, even though the loan is $200,000 and you're paying $843 a month, the least amount going towards your principal is that first month, and the majority is going towards interest. Well, as you continue to, at a certain point, there's an inflection point where now the majority of your payment, in this instance, assuming the loan started June 1st, 2021, the inflection point is around August of 2028. So it takes around 7 years. It took for this interest rate and this loan 7 years before now the majority of your payments are going towards principal versus interest. And that continues to benefit and benefit and benefit over time. This inflection point where the majority is going towards principal versus interest, if the interest rate is lower, it happens sooner. When you look at an amortization schedule of the $843 payment on a 3% interest rate, $200,000 loan, you're paying $843.21 a month for the whole life of the loan, right? For that full 30 years. The first payment is going to be your most paid towards interest and the least towards paid principal. Over time, the principal gets paid, more of the monthly payments going towards principal, less going towards interest. And you see that in this chart showing kind of the inflection point where this deal in 2028 roughly is when there's that inflection point where the majority of, at least the majority of the payment is going towards principal versus interest. That continues to benefit with time. So the lower your interest rate, the sooner this occurs. The lower the interest rate, the sooner the principal inflects, like the inflection point occurs and more it's going towards principal. So when you're owning properties, you're not just looking at cash flow. That's one of the day one benefits, right? And that's going to continue to grow over time. But another huge benefit, like if you looked here on my like using other people's money, private money, yeah, capital raising tab, in 1 year, right, you're getting your cash flow of $19,000 or almost $20,000. Yes, in 5 years, assuming that's like basically the same over the next 5 years, your cash flow is growing. So it's increasing a little bit over time because your income increases and all that good stuff. But really where you start getting massive benefits is, yes, you've gotten $109,000 of cash flow, but you've also gotten, I'm very conservative with my cash flow numbers. And this one is such a high cash flow, low, this specific deal, like this one that we're looking at, not the actual deal that we raised money for, but this specific fake one is such a high cash flow, low loan amount that the debt pay down and all that is lower. But this is an additional of the $109,000. You get $109,000 of cash flow. You're getting almost $200,000 returns over 5 years. So you're getting over $70,000, over $80,000 of benefits, other ownership benefits. And that continues to accelerate and accelerate more with time. So like you're getting $246,000 cash flow, but then you're getting almost $430,000 of overall ownership benefits. This is over a 10-year window. So as you continue to own great assets, you're not only benefiting from cash flow, with time, you're paying down more of that debt. Your properties are appreciation is compounding, and your property, you're getting way more of the ownership benefits. So when you're doing these buy and hold investments, it's short-sighted to just look at the year one cash flow or just the cash flow. You have to look at the ownership benefits and understand that benefits with time is kind of the main takeaway I was trying to say there. I want to work with people that have longer time horizons because that's when real estate is awesome. You know, I talk about the $20,000 a month in cash flow that I'm basically at through my portfolio, but there's like over $80,000 a month of debt pay down and appreciation. Plus I pay no taxes, right? Like I'm getting this massive returns through ownership, and that only will get better with time. Not only will my cash flow increase, but these get better and better with time. What do you do with excess raised? That might get deployed into your next. No. Of that amount that was raised, I said, we're kicking back everything that was, I guess I could have done something more, done all that. I made all my returns. If it was a private money lender scenario, it wouldn't have been a big deal because, okay, there's more money. Cool. We'll just pay you interest on that. And we'll use that for something else. Because it's private money partnership, people's investment returns are based on the $675,000 capital raise and the portion of the ownership they get based on that. So if I was to say, you know what, we're going to keep the $800,000, then that would dilute everyone's shares, right? So then if it's the same amount, we'd have to dilute those shares. And so I didn't do that. I said, return back all the excess funds was basically what we did in this scenario. If it's a private money lender scenario, it'd be different. So this 820, although it says 820,000 was committed and deposited, there was more people that wanted to do it, but in reality, it's only the 675 that we're keeping for this investment. Everyone else who over contributed or contributed more, I asked them to reduce their contribution. So what I did, so they reduced their funds on this deal. In theory, we could say, hey, let's use those funds for a different investment. I know a lot of people just invested in PACE's big capital raise and things like that. So that money went to work elsewhere, or maybe it's on the sideline for another investment that I do or something like that. But the funds excess funds were returned, or not even returned. They were never collected. And I might be raising funds for some of your guys' awesome investments coming up. RV parks. I've got 3 RV parks I'm looking at right now. Potentially I might be raising funds for those deals. Obviously I can always buy more co-living investments, things like that. So if you have RV parks, businesses, and multifamily deals, and capital is kind of your bottleneck, I can come in as a general partner and help you raise those funds, whether we go the fractional route or we just raise it through accredited investors through a normal syndication model, or we just get a few PMPs on the deal or private money lenders, just depending on what you're looking to do. So that's part of my buy box, right? So co-living investments, send me your co-living investments, all of them. If I'm not the one who's the buyer for it, I've got an awesome community of 80 serious buyers and investors that are solid at determining what's a good deal, analyzing those deals effectively, raising the capital for it, or at least understanding the capital raise for it. And they might just need that capital or that deal. So I will funnel the deals to them. So if you have co-living deals, send them my way, all of them. People who need access to capital for fix and flips, cool. I might be able to get you some capital as a private money lender for fix and flips, or if you need capital for your larger assets, multifamily, RV parks, and businesses, and you're a trusted operator, and I can vet the deal and it makes sense, I would be happy to raise that capital for you and see if there's a partnership opportunity for us.